Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Mark.
Good morning.
Right, you've sent 3 thought-provoking slides. I've got to say these are probably the most straightforward ones I've seen from your camp for a long time.
So I think the simple point with this is, we've been fretting about trade wars. We've been fretting about the global economy, above all the Eurozone economy. We've been fretting about politics in Italy, but this week's been risk-on week.
Yep.
And the first example of that is apparently we're all very enthusiastic about the euro again, because apparently next week the ECB will probably announce the end of its QE program.
Yep.
My guess is probably that they'll taper a little bit further for Q4, and we'll get to the end. But the point in fact is that we're still going to get another rate hike from the Fed next week. And by the time the ECB gets round to hiking rates, the Fed probably have done at least 3, if not more. So I'm not really quite sure why we're quite so enthusiastic about the euro, particularly when we're getting the data that we've had. The orders data out of Germany yesterday was very disappointing. The orders data, the industrial production data today, again, somewhat disappointing, -1% on the month. I'm not really quite sure why we're so enthused about the euro, but be that as it may, it's quite clearly we're feeling a little bit worried about the US budget deficit. But if we move on, we can go to the next chart, which is the S&P 500, and despite all the naysayers telling us that the stock market was going to fall, and despite a rather disappointing performance really since we reached those giddy heights back in January, we've been going sideways, and now we look like we're really breaking higher without a shadow of a doubt. And that's despite people talking about the latest earnings season having been very inflated by, obviously, the tax cuts.
Yep.
And saying, well, it's only going to get worse from here. So best we buy some more stocks.
Well, I've got to say, if you had to trade that market, that looks a very, very complicated and messy chart.
Yes, I mean, I think the message here is, I think I said at the end of last year, this year is going to be a lot more volatile, and that's what it's been.
Yep.
It's not been a really discernible trend going on, but it's certainly been a lot choppier, which for the day traders rather than the long-term investors has been good. But for the long-term investors, really, why would one be jumping in now? Well, yeah, okay. In terms of that chart that we've got there, it's clearly breaking higher without a shadow of a doubt now. We may even go and retest those highs from January. It really tells us, I think, most importantly, that despite the Fed rate hikes that we've had and the fact that we're going to get to 1 3/4 2 as a target range for the Fed funds rate next week, there's still too much money in the world, and it needs a home. And long-term interest rates remain very low, despite the rise in US long-term yields, and indeed places like Italy, where we're somewhat worried about what's going to be happening with the budget deficit. Yep. But the enthusiasm for buying into riskier assets.
Market.
Yes, this is a mature market, and it's, I think most people would probably say this is very overvalued, but equally at the same time, they'll probably say we're still actually in an era where TINA and FOMO there is no alternative, fear of missing out, are still very much operating guidelines for a lot of fund managers. And you only have to look at the next chart we've got here to really see how much that's true. This is the average yield of US high yield bonds versus US treasuries, and we're basically back into the middle of the range.
So there's nothing alarming on that chart at this point in time?
Oh, no. I mean, we've had moments, particularly in May, where we backed up the yields quite sharply, 40 basis points. But in the greater scheme of things, when one looks at it, back in August, we were wider in average spread terms. So one can only say that there's been a small concession built in there. But really, every time we get a setback in risky assets, or riskier assets, the dash for trash is still very much operational. Now, that I find quite surprising, given we've got a G7 meeting coming up this weekend, at which the US is going to be extremely isolated. We've also got another meeting going on, which is probably far more important and will be far more harmonious, and that's a meeting of the Shanghai Cooperation Organization over in Beijing, with Russia and China probably looking happy as Larry and probably not being too worried about the world of Donald Trump and his various threats to everybody.
Yep.
And they are going to be bringing Iran into the fold of the SCO, which probably tells us which way the world's going. It's debatable which is the more important meeting. Is it the G7 meeting where we're going to just see basically everyone having a go at the US, or is it the SCO meeting, which will tell us where the major forces in the world are actually developing and what will actually happen there? I still think the latter one is actually probably more important than the G7 meeting, even if for financial markets, the G7 meeting will be far more important, particularly in terms of how can they paper over the cracks, because it's fairly obvious that basically no one is on the US's side at the moment, and the US has done quite a lot of damage.
On that note, young Mark, we run out of time. Thought-provoking as always. Thank you very much indeed. That's Marc Ostwald from ADMISI. Thank you.